What happens if the government makes Bitcoin illegal? That is a question you will frequently hear, and the assumption is the same that prohibitionists made in the early part of the last century, that usage will decrease or even stop altogether if you make something illegal. Not necessarily so. On September the 24th, China issued two documents. One outlawed cryptocurrency mining, the other declared that all cryptocurrency transactions are illegal and any company providing cryptocurrency trading services to Chinese citizens is engaged in illicit financial activity. And here we are, not even a month later, and Bitcoin's up over 50%. It's broken out to new highs against almost every currency there is, even the US dollar, which it passed last night. And Bitcoin's market cap has never been bigger. The network is stronger than ever, and mining simply relocated. And this is now something like the 18th time that China has attempted to ban Bitcoin. Its bans don't seem to have the desired effect. And the reason for Bitcoin's recent rally, certainly the latter part of it anyway, of course, was the announcement last week that there will finally be a listed Bitcoin exchange traded fund, an ETF. And said ETF, the ProShares Bitcoin Strategy ETF, began trading yesterday, Tuesday. It turned over almost $1 billion, we don't know the precise number yet, with more than 24 million shares trading hands. And that makes it the second most heavily traded ETF debut ever. We have been waiting a long time. The Winklevoss twins tried to get a Bitcoin ETF off the ground in 2013 when Bitcoin was just $65. Many others have tried, and here we are finally 8 years on with the price 1,000 times higher. I guess Bitcoin ETFs are a bit like buses. You wait all that time and then two come along at once. This week also sees the launch of the Valkyrie Bitcoin Futures ETF. Now, I used to be CEO of Canadian-listed privacy tech company Cypherpunk Holdings, and I was extremely proud of myself and the team for securing what I thought was the best ticker in the world, HODL. But credit where credit's due, Valkyrie have gone one better. They've secured the ticker BTFD, by the dip, as they say. And it's been hailed as a watershed moment for the crypto industry, enabling it to finally enter the financial mainstream, make it easily accessible to investors of all shapes and sizes through traditional brokers. I am less convinced myself. Call me a grouch. The publicity is good, sure, but Bitcoin has done perfectly well without an ETF. Does it even need one? Crypto is supposed to be an entirely new financial system where individuals take control of their own keys, their own custody, their own money, freeing themselves of the need for intermediaries and trusted third parties. And in that sense, an ETF is like a step back. It feels like French revolutionaries demanding that Marie Antoinette and the aristocracy join them in overthrowing the regime. What's more, this ETF is based on futures contracts, not the spot price of Bitcoin. And I confess I'm a little bit out of my depth discussing the intricacies of short and long-dated futures contracts. If my understanding is correct, though, the fund, which charges a 1% fee, will have to constantly sell expiring contracts and buy longer-dated ones, which tend to be more expensive. And this constant rolling of contracts, excuse the wind, is going to cost money. Estimates say 5 to 10%, and that means the ETF is going to end up not accurately replicating the price of Bitcoin itself, which is the very purpose of the thing. USO was a popular ETF for investors hoping to track the oil price, but with all the complications of rolling futures contracts, contango and backwardation, it always underperformed the price, and it was immensely frustrating for an investor to correctly call a market only for the chosen vehicle not to deliver. Now, USO is by no means alone in its failure as an ETF to actually track the underlying asset, and one hopes that the Bitcoin ETFs and their investors will not fall into the same trap, and I'm sure this is something that has been prepared for, but it is a concern. The Grayscale Bitcoin Trust, which has a market cap of around $8.5 billion, had been the previous way by which traditional investors could buy Bitcoin through their brokers. It's a closed-end fund that owns Bitcoin directly, not futures, and it charges 2%. And as a closed-end fund, new shares are not created as new money buys in. The trust price is therefore determined by supply and demand for the trust, rather than the price of the asset it's designed to replicate. And it has traded at a consistent 20% discount to the price of its bitcoins. Trusts often trade at a discount to their NAV, many perpetually so, which means there is a value proposition there. But that's not why people bought the trust. They bought it to replicate Bitcoin's price, and it hasn't. So what I'm saying is this: if you want to get exposure to Bitcoin's price, then just buy Bitcoin. It involves some self-education that many can't or are not prepared to take on, but that is the sacrifice to be made, and I can't see how synthetic vehicles for mainstream investors will ever be anything but second best. Now, Grayscale is now, I hear, applying for ETF status, and the danger here is that if it achieves it, it will then sell the bitcoins it currently holds, which could actually mean greater net selling than buying. We're at new highs. New highs, way more often than not, lead to more new highs. And this ETF should mean a lot more money flowing into Bitcoin, and that has to be bullish. But beware of the curse of the ETF launch. One final word of warning. I remember the launch of the gold and silver ETFs back in the noughties. And until then, it was difficult for mainstream investors to get easy exposure to gold and silver prices. Buying physical metal was cumbersome. It was hard to make quick entries and exits with all the delivery and quality complications. Futures contracts presented their own problems. The gold and silver ETFs were brilliant innovations to make gold and silver quickly and easily tradable. There was a lot of hype about both in the lead up to their launch. The biggest, GLD, launched in late November 2004, and SLV for silver in April 2006. And we take them for granted now, but they were considerable breakthroughs at the time. And there was a lot of excitement. Gold was trading at about $440 an ounce at the time of the launch of GLD. It rallied over the next 10 days or so to about $450, and then it went into a 2.5-month bear market that saw it go below $415. And when SLV was launched in April 2006, it rallied for a fortnight to $15 an ounce, and then silver crashed 40% to $9. Bitcoin's a different beast, of course, and the mistake with Bitcoin's always been to underestimate it. I'm a Bitcoin bull, don't get me wrong on that. But let's just say, it wouldn't surprise me to see this market rally for a fortnight and all the excitement, and then turn around and sell off, just as the gold and silver ETFs did. Thank you very much for listening. I'll be back with another video very soon. In the meantime, please subscribe. Cheerio.